The difference between Gary and I is Gary is a lot less outspoken. I'm more of Charlie Munger. He's more of Warren Buffett. It's too hard for me to see a moron and not tell them, I'm sorry, you're just a moron. Like, you're being nice about Kathy Wood. I derail Kathy Wood and Jim Cramer all the time saying these people are more. I keep saying Kathy Wood will eventually call retirement and she'll say, my career's over. I'm of the age, blah, blah. When really it's actually going to be because ARK is finally at $15, $20 a share. And people say, you're just a more like kind of thing. So I sit there and look at that and say, like, even the Carnival Cruise Line thing. Well, yeah, it's good that there's a lot of cruise lines that have debt, but what would stop all the cruise lines from going under?
Yeah.
It's not an egregious thing. I don't know. I can sit there and say,
possible.
Yeah, it is possible. The cruise lines don't have Google and Facebook and Microsoft and Apple's balance sheet. Right? They have a very different balance sheet. It's hard for a company with not net positive, cash versus debt to go under.
Yeah.
Those are the things that I think about, but that's why I like diversification. So like I look at a guy like Warren Buffett who says, hey, if you really know what you're doing, you should have 8 or 10 positions and you're good. But for me, I'm like, hey, I reasonably know what I'm doing. I'm not on your level, but I'm not on other people. I always sit there and say the average investor is 10,000 foot view. I'm probably 100 or 200 and you're in the 5 to 10 view, if not lower.
But I think you're aware of this. See, like, I think that's
my point. I'm also aware of it.
The point is, I kind of like when I mentor my interns, I try to help them build their own investment style by studying the masters, right? And I tell them like, the different dimensions of investment styles work together. Like how concentrated you are should be a function of a bunch of other things. That it's not like you decide, you don't start with, I'm going to be concentrated. It's an output. It's not an input. It's an output.
Can I interrupt you?
Sure.
People say, why aren't you more concentrated? I say, because I'm lazy. When you made the joke earlier before the show, it's like, I don't want to go interview suppliers. I don't want to go interview corporate headquarters. I don't want to interview any of these people. I want to sit there and pick 30 or 40 companies that have certain quantitative aspects that I like out of 200 that already have the quantitative, and I've weeded them out into the qualitative aspects that I do like. That's the laziness factor. I go, listen, I've always said in the show, people say to me, well, how much research did you do? I said, I don't know. Gary researches ex-employees. I don't do that. Like, I refuse to.
And I don't always. I mean, like,
you don't always, but you do.
The thing is, like, I don't do primary research to check the box or to impress someone. There are times where, like, you start with what's the key question. At Carnival, there's no one to interview.
Right.
Like, I mean, like, it's just, we don't know what's going to happen. And the question is, how do we assign probability? We know we can estimate the magnitudes very well. Like, okay, if things are restored, we kind of know whether they should be earning, especially since we know what the land-based vacations cost, and so we can kind of triangulate what they will get. What we don't know the probabilities very well, right? Who are you going to interview? You can interview. I mean, look, the CEO probably doesn't know. I mean, of course not. No, nobody knows. I mean, but people might have insight versus a company where, let's say, a new CEO takes over and you interviewing people who used to work with him to get a sense of his style, culture he's built, because you're trying to piece together. Is that going to be the only thing you care about? No, but you're putting, it's like the cliche of the mosaic theory. It is true because you're putting together, okay, like one thing I've learned, I was talking to a friend of mine who's an investor. I'm like, I feel like I'm getting older and like I'm just tired of dealing with bad managements. Because when I was earlier in my career, I would be like, but it's really cheap. But it's really cheap. And I still feel I sometimes do that. And again, definitely not going to
So you're becoming the old Buffett to now the newer Buffett.
I don't know what to say. Although the old Buffett had pretty good returns. 50% a year. But, it's like you have I had this company, and every time I talk to the CEO, I was like, no, it's just not my kind. And I'm like, does that matter? I don't think do I know that he's doing something bad? No. He's always talking about the stock. He's always talking about like how investors perceive the stock and all this stuff. And I'm like, and I'm like, dude, just run your business, man. Like, let's talk about your business. Let's stop talking about your stock. Let's talk about how we, competitive dynamics. We talk about this, like, I don't want to say it that way, but I'm kind of trying to steer the conversation. And it's just like, and then it's like, I mean, it's just is that the luxury of like, okay, someone is a billionaire, they can say, I'm going to just own Coca-Cola and I don't care if it's fairly valued because I like the people, I like the company, and I'm not going to sell it. Okay. Maybe I don't know if that's what it is or not. So is it like a luxury of being rich and wealthy and like not caring, or is it actually better to work, like to avoid people where you're like, I'm starting to lean to like might be better, which again goes back to concentration.
See, he's joining our team on this one because
really.
we've been saying this.
Well, but
I have a question for you about margin of safety after. Go ahead.
Yeah, no, I was just gonna say, but the more constraints you impose in your universe, the more concentrated you're gonna be.
Yeah.
Because if you whatever the qualitative filters, right, that's gonna give you the pool of companies that pass the qualitative filters, and then there's the price filter, which is always the final filter, right? And so if you over constrain the problem, you're gonna come up with a null set, and you say, well, I'm fine, I'm gonna have cash a lot of the time. Seth Klarman, wrote once that people who understand Baupost or people who don't understand Baupost think that the track record was developed despite the 30% cash, average percentage, and the people who know Baupost well understand it's because of it. But this is the big but. He had the things he swings at times of distress when the opportunity set is rich, are very high IRR, right, rate of return opportunities. They're not. True, he did buy some mega caps and he has a lot of assets, but he'll buy a liquid commercial real estate. He'll be the lender of last resort on some, bank, buy some bank debt at 30 cents on the dollar or some esoteric, whatever, right? That's just not what I do, right? So you have to be careful when you're copying something and saying, oh, I'm going to do this because someone else, to your point, it fits with other pieces of what he's doing. I'm not swinging at, bank debt. It's just not within my circle of competence. So you have to be careful. If you're going to over constrain the problem and end up holding cash a lot of the time, when you invest, your IRRs need to be tremendous to offset that on a multi-decade basis.
Mm-hmm. Yeah, and I think it's funny. I tell my brother and I tell Mo when it comes to real estate, that's so easy for me. I'll sit in cash for the longest time, but when I swing, it's the big numbers. You know what I mean? And that's what I like. And I'm not there yet on stocks. I'm not there. It's funny. I remember once reading Munger basically saying, yeah, we just know what's going to happen. Like he was in a very, it sounded more arrogant than it was intended to be, but it was very like, listen, if we're swinging, we're very, very confident that what we're swinging at is going to end up working out pretty well. Mm-hmm. So anyway, what's your margin of safety
when you're looking at these smaller companies, we get a lot of questions about margin. When Paul and I look at a margin of safety, we put it on our model. We'll put in a 10-year analysis and we'll make the return 20% versus 12.5. We'll decrease the revenue. Something if we're looking at a Carnival or something. When you go to these companies and you're talking about $100 million company, do you have a general blueprint of margin of safety? Does it differ if you're looking at some type of mid cap, large cap?
It should,
because I've always wondered that
before he said market cap doesn't matter, but I believe the market cap should drive some elements of your margin of safety.
At the extreme, sure. If it's like a guy in the garage and it's like a company of one, and there's
Google.
And there is Google, right? The resiliency versus the fragility of the company is obviously very different between the two extremes. Mm-hmm. Now, if we pull in from both of those a little bit, and if you're talking about a company that I'll just stick with OI Glass. Is OI Glass?
What's the market cap?
A couple of billion.
Okay.
It's small, but it's not tiny. It's not micro cap. Is OI Glass more fragile, less fragile than a 20 billion manufacturing company that just happens to be in a different niche? I'm not convinced. I'm not sold on that.
I can buy that.
Now, but let's go to like the small, tiny, like the 100 million, where you really are, or 50 million. You really are talking about a company that maybe has 100 employees or something like that, right? Or 50 employees.
That matters to me.
That matters. But again, it's not just the number of employees. It's like, one of the questions I always ask is, if the company disappeared tomorrow, who would care? Mm-hmm. And also, how much time and money would it take for someone else to make it a bad business? Mm-hmm. Right? What would, like if Microsoft woke up and decided to, and that kind of obviously leads down a normal path of competitive advantage.
Moat.
But also, there's like a lot of things that people what Graham was looking for is predictability. Mm-hmm. He's looking for situations where the past is a good prologue for the future because there's some fundamental reason for why the past results that were achieved, and that reason is still valid. So he's not blindly saying the average 10 years of earnings, those are X, I'm going to multiply it by a multiple, I'm going to buy it, because obviously that would be very easy. But there are times where you're buying the horse buggy whip manufacturers. Horse buggies are going out of business, right? And you're looking in the rear view mirror and you're doing it the wrong way. So or you buying into a taxi cab company when Uber, right? Whatever. There are many examples. The point then is, how do you find these elements of predictability? Which to me, the margin of safety qualitatively comes down to predictability, because if I'm buying, my portfolio might be on average right now at 5-6 times earnings, what I think are normalized mid-cycle earnings. Maybe 7, between 5 and 7. I don't remember exactly, but it's if you take the inverse of that, 1/5 is 20, right? So if assuming it doesn't shrink, and 1/7 is whatever 14, obviously, right? So the question is, where am I going to be wrong? Where is there a chance for, like that Faro example where it was instead of 2.50, 25 cents? What's preventing that, right? Like why can't this business just get cut in half, tomorrow, right? And if it did, one of the tools that people like to use is called pre-mortem, right? Doing a post-mortem before it happened and saying, okay, let me do a pre-mortem on why I failed in this investment, what went wrong, right?
I just read about that. What book was that in? It's written around a lot, but a lot of people do that.
It's in a lot of behavioral books, but it's kind of it's a good standard practice, right? And so I think but to come back to your margin of safety, yes, there is more fragility. So what I don't want is I don't want to compound it. So I don't want to have a risky balance. So the 2 microcaps I've invested in, so again, Paul is making it sound like I'm like a pink sheet expert.
No,
but
I think our viewers understand because we have said you invest in much smaller companies.
Much
you
smaller,
do serious
right.
due diligence.
I do, but I'm also wrong some of the time.
Well, of course you're going to be wrong.
That doesn't mean
I think the only person who wasn't wrong was Bernie Madoff, and we know
Exactly.
how that worked out. My point
Rest
though
in peace.
is that the 2 microcaps, I had net cash balance sheets. So you don't want to compound fragility. So, if you're taking a business that's, maybe certainly could be more fragile than something else, you don't want to compound it with, business risk plus balance sheet risk. So and in each case I had a very strong cash support or asset support, where if I was right on the downside, it was very asymmetric. Where what I was saying was basically, look, I accept that there's more business fragility here. I'm not oblivious to that fact, but I'm also saying that the balance sheet being, if the company were liquidated tomorrow, then my downside would be not very much. But the risk I was taking on, and in some cases still am, is that what if the management f's up and they don't liquidate it tomorrow, they mismanage it,
they piss away the
account. That is a real risk. And and we talked about, my one activist investment was basically I saw the chance of that potentially could be happening. And that's when I filed my one and only 13D, of silvering, is because I'm like, don't touch my cash, because that, that changes my thesis, right?
Yeah.
Because that business was not Google-esque, in its moldiness, right? That business, it was kind of like a call option attached to a net. That was the appeal, meaning huge asymmetry. Heads you win a lot, tails you don't lose. Yeah. If I was right on the analysis, that was the appeal, not that the business.
How did it work out?
It worked out really well, but I would say that we got a little bit lucky. It worked out really well, for us.
So,
but I actually trying to learn from. I'm trying to strip away the worked out really well and ask myself on a process basis, do I want to do this again?
Or was it?
I'm not sure.
Yeah.
I'm not. Yeah. I'm not. If I were to do a Monte Carlo and do this 1,000 times, what should my outcome be? I think in that case, I should have still made money, but we did better than probably the expected value was.
So this is the whole idea of behavioral is a very big thing for me on the channel. I use the quantitative to drive a lot of my initial looks in companies, and of course I'm going to miss things. I'm okay with that. What I'm looking for is opportunities where I can buy a large company where I think there might be a slight mispricing, and if I buy 30 or 40 of them with a slight mispricing, I'm okay beating the market by. I think Ben Graham talked about his goal was 2 to 3% a year.
Yeah,
and I look at that saying, okay.
Yeah, and I think that's realistic. We talked about it. I think that's what you should there's a number of funds that basically do that. By the way, there's pretty much no mutual funds that do what I do because it's bad for their business model.
Well, the career risk is huge.
Yeah, no, it just doesn't make sense from, there's all the benchmark hugging. But even if you want a high quality 25 to 30 names, 5 billion plus. There are many. There's a lot of people hunting for that. I think you're good. I think you'll add value, but I don't think you should expect to beat the market by 5% a year.
Oh, no. But I do call options, and we talked about that before.
Yep.
And that's something we'll talk about at dinner tonight. But, I sit there and say, if somebody said to me right now, Paul, you are capable of doing 25% a year for the next 30 years, and here are the things to do, and it involves interviewing people, no thanks. Because I'm in a different position. So Gary, and this is what I always tell people, if people in our community who buy our software will be like, Paul, what do you own? I'm like, guys, first off, no. Secondly, I have 8 or 9 businesses upstairs. Gary here is an investor. I think Gary does a great job of interviewing clients ahead of time. People have asked me before, Paul, tell us about your friend Gary. What are his returns? You know what I say? I have no idea. I literally could not care. I recently wrote Gary an email, which I was happy to see he was down last year. I was like, thank God, if I opened this email and he was up, I might have murdered him. But he was down. I'm like, thank God. But I believe in Gary's process.
I appreciate that.
Well, the funny part is you look at that and say, how many people really do that? Not many.
Not a lot. Honestly,
and that's why Gary's fund is small, because you need to find those investors.
Well, the best investors are kind of cyclical. They add capital based on opportunity set being attractive, not based on trailing returns. How many funds have been raised by, slick hedge funders who put up 3 years of something and then go and market the heck out of it?
That's what mutual funds do. They take 20 funds, and the 4 or 5 that do the best,
they cherry pick.
Right.
They cherry pick.
Of course, that's true. But even worse in the hedge fund, because people go hockey stick up, and they create all this narrative, all this bullshit about this, but so they're almost incented to gamble, right?
Kathy Wood.
I'm not gonna go there.
Kathy Wood.
They're incented to gamble because that's the only way they think they can build a business is get these big CAGRs. And so again, I'm not going for the highest CAGR.
By the way, CAGR,
compounded annual growth rate.
Thank you. In case people are watching
quiz. That's water, not vodka. I still got it. I have my family's money in there. My mother's saving money that I'm giving my mom for our retirement. Yeah. I'm just not I'm not interested.
You have my pocketbook. You have my petty cash.
That's right. The stuff that you wouldn't bend down to pick up, the nickels and the dimes. I understand. I get it. But seriously, right? I just the people who select investors on process. A 1 in 100, 1 in 1,000. Even these institutions, and I don't
You're welcome.
Thank you. I don't.
That was the first thing you told me leaving the dinner that we had.
I don't want to rag on institutions, but
I've
talked to a lot of these endowments, foundations. So many of them put on the airs we do deep diligence.
Oh, bullshit.
I love to see.
I think it's true for.
No, it's not.
I think it is true for a small percentage of them.
Oh, for course.
But I think for a lot of them, they're basically putting the makeup on a pig of they're jumping on some bandwagon manager that's in style, but then they're creating a narrative for their board. So we chose them for the and it's how many times did you invest with a manager who was going through a terrible period, as their first, not to give them credit. I think sometimes they will double down with a manager who is going through a tough period where they already gotten to know them, but how many times did you put someone through your process, through the board committee, where their 3-year CAGR wasn't at least decent? And you said, you know what? This is the exact right time to invest because the person's process is great. Their whatever is great, but the opportunity set is amazing. But they're out of favor. We should invest with them. If you're email me, strip the names away. But I would love to hear 5 stories like that.
It's BS, and it's not going to happen because
maybe Yale or whatever. Maybe the very best of the best.
No, even then.
But I honestly think.
You think Yale, the biggest endowment in university history, is going to do that?
I think that there's a small group of legit people, but it's
maybe
a tiny part of Well, Seth Alexander was worked at Yale before, and that's kind of the culture he brought on with changes, and so forth. I guess the reason I'm mentioning it is I think all these sophisticated investors, it comes down to what have you done for me lately? It's really
they're not investors.
They're not that sophisticated. They're
show
not
a full market cycle.
Yeah, right. Well, so I think that's why I'm not in a rush. My belief is process matters in the short term and the intermediate term. In the long term, the numbers have to be there. It doesn't you can have whatever process you want, but if your numbers suck over 20 years,
and your process sucks,
then in process or how you implementing it sucks, right?
That's doing part of the something process.
wrong. Process to me is a set of rules or guidelines you use, and then it's
Well, part of the implementation is the rules.
No, well, like diet. Okay, there's a diet. You should exercise like this, and you should eat like that. And then they're sticking to the diet, right? That's why I have the extra 25 pounds. That we talked about earlier, right? But I don't have the extra 75. And right? It's like I've succeeded complying 2/3 of the time with my kind of like my plan on my diet.
Want some Oreos?
What?
Do you want some Oreos?
Yes, with sprinkles, deep fried, please. So like I think that you can have a good And by the way, like I've been in the institutional world. So before I started silvering for 15 years, I spent in a few large firms, and I remember like I was always curious, when would someone in the due diligence session call bullshit on like some of the stuff? But I wasn't the most senior person. You know where the weak spots are.
Did you ever call bullshit?
I would call bullshit in private, and but like when the potential client is sitting there and they're looking at the deck, and the PM is spewing their bullshit, and it's not always bullshit, but it's the kind of like sugar-coated, prettied up, version.
Sugar-coated is a nice word.
Yeah, it's bullshit.
Okay, but
just ignore me as I say.
I don't want to get stuck.
I
don't want to get stuck on this one term. But and I would have I'm like, when is that guy is going to say, actually, here on this list, walk me through how this investment fits, which you just said. Mm-hmm. And they never did. They always let you cherry pick the examples.
Yep. It's like Tesla. When I hear, I always tell people, the second a value investor tells me, the second a self-professed value investor mentions crypto or Tesla to me, gone. I'm sorry. They very well could be right on both of those, but it would be right because of luck. I just look at that saying, I don't know. So I told you the story about like, so the student wrote you the email.
Yeah. Well, he got mad because he wrote me this email. He watched your video or read something where you portrayed, you mentioned this, and he's like, Gary, I wrote this to you in confidence, or something like that. And I said,
sorry, Gary.
No, it's fine. But I said, listen, I never told you the name, and I said, here's what I told you, and if and he was okay with that. But he thought I was like making fun of him individually, and I would never do that. But that student literally was, and by the way, at the end of the semester, he sent me a full-blown analysis on Tesla to his credit. He said, look, I know we disagree, but I respect you, and I would like your feedback. Here's my DCF. Here's my forecast. Like, tell me, and I respect that, because, I mean, look, when I was 20, I was also full of myself, and I thought I was way better than I was, whatever. But at least he's willing to do the work, and he's not doing this. Elon Musk is amazing, and I'm gonna stop at that, and kind of stuff.
So first off, I apologize if you got in trouble for that one. I didn't think. I mean, I guess we're way more famous than we thought. So. I mean, I just.
No, it's all good because honestly, like I wouldn't have told you the name.
You never told me the name.
Basically, if I were to do something like that would be wrong, and he should by all means call me out on that because it was like the whole point of the discussion is it's not about like I'm not making fun. I use this point to show this the sign of the times, right? Mm-hmm. When someone who knows that they don't know because they're taking my kind of seminar, they know that they're not like the market wizard yet, and yet they're so confident that they're gonna the $1 trillion market cap and that they're like convinced that this is amazing, right? It's like not quite cap.
By the way, it's a discount now. It's only $940 billion.
I'm in.
Well, again, not gonna talk about Tesla for the same reasons. I'm not gonna talk about Cathie Wood. Leave that to you. But I mean, in all honesty, right? It's a sign of the times that people like. And by the way, I've done this for a few years now. This is more last time was the most kind of like people were like there'll always be some growth here people in there, and there'll be a healthy debate, and I will encourage that because I'm like, I'm not trying to tell you should have a Ben Graham style. Right. I'm trying to expose you to alternatives, give you my view of the pros and cons, and give you the tools to then evolve to direction that you think fits your strengths and weaknesses. I mean, there are people running around like saying you should clone Warren Buffett, you should be a cloner. I completely disagree.
And Monish Pabrai believes in being a cloner.
I am not. Again, the same reason I'm not going to mention Cathie Wood. I'm not going to go by name, but I completely disagree with the cloner mentality because, and I could disagree more strongly in private with using some examples, which I will.
We'll do it dinner tonight.
Dinner. But the more general thing is you don't have the strengths and weaknesses that Buffett has. You don't have the specific circumstances, and you should really investing, and maybe this is, I don't know how you're doing on time, but like it's a journey of like learning about yourself, right? Mm-hmm. And as you study and you learn mistakes, like I've learned, like I go on hikes a lot, in nature walks. It sounds like I'm not doing work, but it helps me think. And if I go on a hike and I think about my portfolio, I can reflect as I'm with nature, and something is bothering me, That's a sign that something is unbalanced.
Right.
I try to have a pretty balanced portfolio. What I mean by that is I have some pretty strong personal views on where we're in the cycle or what might come next. But I'm trying to create a portfolio where in no path do we do terribly, and in most paths we do pretty well. Now, by necessity, that's not going to do as well as if you put a bet all on black, right? And say, so if you want to have the highest possible return, you bet on one outcome.
Right.
Because once you start to managing risk, you inevitably taxing the best outcome to make sure that the worst isn't that bad. But so when I walk in the woods and I get this nagging feeling, this position, like that's my mind telling me, and I know my comfort. And like when I return to, nothing is bothering me, that's my happy place. And I want to be there because that's, maybe finish on this, behaviorally where you're going to make the best decisions. You cannot make great decisions from a point of view of behavioral discomfort.
You mentioned that about walks and you think about these things. So one of the other things I tell people is, you've joked with us about our financial situation. And this is a big thing when you think about Buffett. The big reason I tell people don't mimic me is because I have so many streams of cash flow that if I sat in cash the rest of my life,
it's fine.
It would not affect my life today, tomorrow, or 60 years from now. So I'm going to make investing decisions a lot different than everybody else.
Exactly.
If I just did options for the rest of my life, I would make enough return where my real growth, and I'd sit there not to brag, but to say, all the more reason you don't follow me. It's like the Warren Buffett.
Yeah.
You don't have all these things. So one thing I did want to bring up, and this is, I hate to say it, it's different this time. How much of Warren Buffett's portfolio is because of a lack of information that he had 60 years ago that was out there versus what's available today? Back then, one, to even find people to buy shares from, and two, to even even be able to read the financials took how much effort versus what we have today. And I'm not trying, but the flip side of that is I tell people, I really believe this, the bad times will maybe be worse because of the behavioral side of things. The pendulum will swing at further extremes potentially now versus 1930, 40, 50 because of if we see 3, 4, 5 years of negative returns in the market, we did it in the early 2000s. Imagine we saw it today, 20, 30% a year for 3 or 4 years.
Right.
That would make people feel.
It would make them feel real.
I mean, the thing is, again, I'm not a market prognosticator, but it is funny looking at people like writing, in the new bull market,
everything's done.
It's over.
Yeah, I mean, so
bear market. What?
It's possible that they're right.
It's possible.
It would be probably an unprecedented event in like the history of human psychology, not just like the last 100 years that everyone quotes, because like extreme, like think about how extreme, like in this century, this is like, in the last 100 years, so not the 20th, but like the last 100 years, this is the 4th time this happens, basically, right? That you have complete, like, parabolic kind of, and everybody, Joe Blow is...
And what happened the first 3 times?
Yeah, right. Well, and we don't know, but I mean...
we do know.
I'm saying we don't
way.
know about the prior 900 years, right? We know like the South Sea, like we know...
The tulips,
right? But there's a fascinating book about... There's actually what are they called? The Greater Courses or Great Courses. There's a series. No, not Master, but there's a Great Courses on Audible books by actual professors. Highly recommend it.
Tim knows.
Yep, and basically he talks about like market crashes and delusions, not delusions of crowds, but like, and he goes through every instance of the last 300-400 years, and it's always the same. Like like exuberance.
You're wrong, Gary.
Exuberance. I could be. So here's the thing.
No, you're not wrong.
You can have strong beliefs, but you still have to think that there's a decent chance you're wrong, which is why
decent. What do you consider decent?
Well, listen. So if history is a guide, then
0% chance.
Exuberance like this should at some point next few years be followed by despondency, right?
Yeah, yes.
People go from, like when do these
irrational exuberance to rational despondency?
You have 14-year-old kids that think that they're Warren Buffett.
I know. Well, so when is the bottom? Not in terms of time, because anyone who tells you when, no. But what conditions should be present at the bottom?
So can I tell you?
Yes.
My friend Michael Moskal, he's not going to... But he says, Paul, when I see people giving up on Apple and Tesla,
yes,
I'll sit there and say, we're probably pretty close, if not at the bottom.
Well, so this is what I realized. So like when I took Intelligent Investor to the beach, and he was talking about the sell-off of the 70s, right? Early 70s.
I should read that again.
The sequence of mental capitulation is as follows. First, the bubble stuff, the air comes out. And in that time, it was the conglomerates, and the Nifty 50. It was radio companies in the 1929. It was telecom and media and internet stocks in the last one, and this time it's whatever. It's SaaS, EV, whatever, right? So that has kind of largely happened. Maybe there's more to go, maybe not. But 70 to 90% decline, pretty legitimate declines, right? Whether there's more to go or not, who knows? The next tier is the off-the-run second line companies, as Graham called them. These are small. These are like what I own, fortunately, right? So I'm aware of that, right? So the OIs of the world, they're not going down or not because of fundamental reasons. They're in someone's basket, some quant basket of small, right, financial leverage, this, that, whatever, right? And the final leg is when the blue chip companies decline, because that's when like the death of equities kind of articles get published, right?
Yeah.
The Business Week, right? And like people are disgusted because like they got wiped. Like who's got really wiped out here? Okay, a bunch of speculators, and maybe some guy who thought that they could get 25% interest per year loaning to some crypto fraud bank or whatever, right? Okay,
one of my favorite stories.
I'm a little bit of a believer in libertarianism and Darwinian survival. I mean, those people deserve kind of I don't think they needed extra protections if they think that 25% like or whatever interest rates
during a zero interest rate environment.
Like, I mean, like if someone comes to me and like says, you and I talk about on LinkedIn, they have a lot of connections, people connect and they pitch some bullshit, right? And it's like, hey, would you like to earn a safe 18% return? And my answer is like, I would love to be able to deliver and say, I can't do that. So you're good at and the best thing is the details. I used to delete them, but now I actually want to read them.
You have to read them.
It's so fun.
Because like these guys, like it always sounds plausible enough. It's like, well, where's the catch? There's always some catch. There's always some tail, kind of.
The catches are scamming you.
Right. Well, this is a little bit of a tangent, but like another partner of ours emailed me the other day. He has some money with a wealth manager and some with me, and he said they're doing this funny option strategy. Could you take a look and explain what they're doing? And I'm not like the biggest options guru, but I understand the basics. And there was basically they were selling puts on the S&P, 10% of the money every month. Put spreads, sorry. They were selling put spreads. Basically, what they were saying is, think of a giant steamroller coming down, and they were the kind of coins that you don't pick up, Paul. Nickels. Sorry, I gotta keep picking at you.
They want to pick up nickels and dimes.
Nickels and dimes, right? But as long as they keep picking them up, they can show it to their clients. Say, oh, look, we're getting riskless returns. What they're doing is they're taking on tail risk. That they're gonna one time. It's like. The better analogy I like is like the sleeping alligator with a $20 bill, so to get your attention, and the guy who says he's really good, he says, listen, and he has a slide deck telling you how I'm a really good $20 bill from the alligator jaws picker, and here's my track record of the 9 times I've reached into the alligator's jaws and I got the 9 $20 bills to show, and then the 10th time, of course, the arm jumps off, and that's it. And so there are all these strategies that have this profile: frequent small to moderate wins, followed by occasional, kind of reinsurance kind of the tail risk, right? And that client didn't, and that was one of the smarter. I'm sure that he was one of their smarter clients. Like, so when people are doing stuff like that, right, where that is not close to any kind of bottom, right? They're like basically saying, I'm gonna write insurance, and by the way, like, maybe this person is worth 20 million. I'm guessing, I don't know, whatever, right? That every time they were exposing them to like $1 million risk on this thing. This is like a lot of money just for a month. Presumably, if they ever get triggered, these guys will get angry and probably write another one because like, this is a one. And then they would talk about to their clients how this is a 1 in a million year event. It could never.
And by the way, it's not, because you just look at the deltas of it, and that basically
it'll tell you.
Yeah, it'll just basically tell you this is the chance of it happening. And by the way, we're very big. We talk about options all the time.